Aston Martin sales to dealers surged 82% last year, boosted by its first SUV, but the company was hit by delays for its premium Valkyrie sports car. That's according to the British luxury automaker Friday. Aston Martin said 10 Valkyries were shipped in the fourth quarter, fewer than planned. It blamed supply chain challenges and a complex production ramp-up. The carmaker, fictional agent James Bond's favourite, forecast annual core earnings of $20 million lower than expected. Even so, it sold 6,182 cars last year, helped by demand for the DBX sports utility vehicle. And it isn't the only luxury car maker to score big sales. Travel restrictions have left wealthy consumers with more money saved up to spend, and many have turned to premium cars. Britain's Bentley reported a record year Thursday as global sales jumped 31%. Since going public in 2018, Aston Martin shares have fallen around 30%, and the company has burnt through money. But the firm said its cash balance at the end of 2021 was higher than expected at around $569 million. Aston Martin shares rose around 3% in Friday morning trade.
There's no relief in sight for European consumers. New data Friday showed inflation hitting a fresh record high. Price rises jumped to 5% in December. That surprised economists who had predicted a more modest gain. Energy costs were once again the big driver, up 26% on the year. They've been driven higher amid soaring prices for natural gas around the world. But that is far from the only concern for Eurozone households. Prices for food, services and imported goods also rose far faster than the European Central Bank's 2% target. Some temporary factors came into play there, including a splurge in spending by people who saved cash during lockdowns. Now views differ on how fast inflation will come back down. The ECB thinks it will be back below 2% by the end of the year, but many influential policymakers think high inflation rates will persist well into 2023. For now, though, the central bank isn't expected to take any action. The ECB moved to curb its stimulus spending only a few weeks ago, and no big policy shift is now seen likely before March. Head to McDonald's in Japan right now, and you may come away a little hungry. The fast food chain said Friday it's running short of potatoes, and that means customers can only have a small portion of fries. McDonald's Japan says it's down to flood damage near Vancouver and assorted shipping problems. That includes health crisis-related issues, extreme weather events, and an upsurge in global demand. As a result, it will only serve small fries for about a month. It had to take a similar step during December at its roughly 2,900 branches there. Disgruntled McDonald's customers may not know it, but they're at the mercy of global events.
Job growth in the U.S. lost further momentum in December, surprising analysts. The Labor Department reported Friday the economy added just 199,000 jobs. That was half of what Wall Street had been expecting. Economists say the slowdown in job gains was due to a lack of available workers. Still, the report depicts an economy that ended 2021 on a high note, creating a record of nearly 6.5 million jobs last year. The employment market is rapidly tightening, as seen by the jobless rate, which tumbled to a 22-month low of 3.9%, even as more people entered the workforce. Glassdoor senior economist Daniel Zhao.
That does really signal that Americans are finding jobs, and this improvement is much more significant than what we've seen in the payroll growth. And so I think that's a positive sign as we head into the new year.
Sectors adding the most jobs: leisure and hospitality, professional services, and manufacturing. The spike in infections from the Omicron variant likely did not impact the report due to the survey's timing. But the variant's hit to payrolls will likely be felt in January, so job gains could remain moderate. Analysts said the report is unlikely to affect the Federal Reserve's plan to raise interest rates earlier this year. but it sent stocks on Wall Street lower in early trading and Treasury yields higher. Wall Street had a choppy start to the new year, wrapping up the week with losses on the day and the week. Looming interest rate hikes made investors skittish about stocks. The latest U.S. labor report out Friday showed the jobs market was at or near maximum employment, even though jobs growth rose far less than expected last month amid worker shortages. Warren Financial CEO Randy Warren.
I think it says the economy is pretty strong, and we should be expecting a reopening surge in the economy.
That thinking fueled bets that the Federal Reserve would aggressively tighten monetary policy, pushing up Treasury yields for a fifth straight session. And that sent interest rate-sensitive tech stocks down, but economically sensitive sectors like bank and energy up. The Dow finished nearly flat. But tech stocks dragged down the S&P 500 0.4% and the NASDAQ almost 1%. The favorite of the meme stock crowd, GameStop, jumped 7%. The video game retailer said it will expand its marketplace for non-fungible tokens, which use blockchain to record ownership of digital items such as images or videos. No jab, no job. Citigroup gave its unvaccinated employees in the U.S. until January 14 to get the COVID-19 shot or get fired at month's end. Shares rose more than 1%.